Hey everyone, welcome back to Simple Mind Space. Today, we're diving deep into the world of stocks. Consider this your crash course, your one-stop shop for mastering the basics of investing, even if you're starting with absolutely zero experience. We're going to cover it all, from understanding what the stock market actually is to building a solid investment strategy that sets you up for long-term financial success. So why should you even bother listening to this? Why is investing so crucial, especially right now? Let's face it, we all want to achieve financial freedom, right? We dream of retiring comfortably, having the means to pursue our passions, and simply enjoying life without constantly stressing about money. Well, investing in the stock market is a proven path towards making those dreams a reality. Think of it this way. You work hard for your money, so why not put that money to work for you? When you invest, you're essentially giving your money the potential to grow at a rate that outpaces inflation, meaning your purchasing power increases over time. It's like having a silent partner who's constantly generating more wealth for you, even while you sleep. Now, before you get overwhelmed, let me assure you that investing doesn't have to be complicated. In fact, one of the simplest and most effective ways to get started is by understanding the power of index funds. These are like baskets of stocks that track a particular market index, such as the S&P 500, which comprises 500 of the largest publicly traded companies in the United States. By investing in an index fund, you're essentially spreading your risk across a diverse range of companies, which makes it a much safer bet than picking individual stocks, especially for beginners. Plus, historically speaking, the S&P 500 has shown an average annual return of around 7%, which is significantly higher than what you'd typically earn in a traditional savings account. But before we get ahead of ourselves, let's go back to the basics. What exactly is the stock market? In essence, it's a marketplace where buyers and sellers come together to trade shares of publicly listed companies. These companies have decided to offer ownership stakes to the public in exchange for capital, which they can then use to grow their businesses. When you buy a share of stock, you're essentially becoming a part owner of that company, albeit a very small one. As the company performs well, its value increases, and so does the value of your shares. Conversely, if the company struggles, the share price may decline. Now let's talk about how to actually get started with investing. The first step is to open a brokerage account. This is essentially an account that allows you to buy and sell stocks. There are tons of different brokerage platforms available, but some popular options for beginners include Robinhood and Webull. These platforms are known for their user-friendly interfaces, making it easy for even the most tech-challenged individuals to navigate the world of investing. They also typically offer commission-free trading, which means you can buy and sell stocks without having to pay any fees. Once you've opened and funded your brokerage account, you'll need to decide what stocks to invest in. As we discussed earlier, index funds are a great option for beginners, but you can also explore individual stocks if you're feeling more adventurous. However, before you hit that buy button, it's crucial to do your due diligence. This means researching the company thoroughly, understanding its business model, analyzing its financials, and assessing its growth potential. Remember, knowledge is power when it comes to investing, and the more informed you are, the better equipped you'll be to make sound financial decisions. Another key concept to understand is dollar cost averaging. This is a strategy where you invest a fixed amount of money at regular intervals, regardless of the market's fluctuations. By doing so, you're essentially averaging out your purchase price over time, which can help mitigate the risk of investing all your money at once, especially during volatile market periods. Investing can seem daunting, especially with all the jargon and complex strategies out there. But remember, it's a journey, not a sprint. Start with the basics, educate yourself, and don't be afraid to ask questions. Remember, the best time to plant a tree was 20 years ago, but the second best time is today. So, take that first step, start investing, and watch your financial future blossom. Now, let's shift gears and delve into some more advanced investing concepts, particularly some of the strategies championed by legendary investor Warren Buffett. Buffett, often hailed as the Oracle of Omaha, is renowned for his value investing approach, which emphasizes identifying undervalued companies with strong fundamentals and holding them for the long term. One of Buffett's core investing principles is focusing on companies with a wide moat. This moat refers to a company's competitive advantage, its unique strengths that make it difficult for competitors to erode its market share and profitability. A moat can take many forms, such as a strong brand reputation, a loyal customer base, a cost advantage, or a unique product or service. Companies with wide moats are often better positioned to weather economic storms and deliver consistent returns to investors over time. Another key aspect of Buffett's investment philosophy is the importance of strong leadership. He believes that a company's management team plays a critical role in its long-term success, and he seeks out companies led by ethical, competent, and shareholder-friendly individuals. Buffett also stresses the importance of understanding a company's intrinsic value, which is essentially its true worth, based on its assets, earnings, and growth potential. He believes that the stock market is often driven by short-term speculation and emotions, leading to mispricings that create opportunities for savvy investors to buy undervalued companies. Value investors like Buffett are patient and disciplined. They're not swayed by market noise or short-term fluctuations. Instead, they focus on identifying companies with solid fundamentals that are trading below their intrinsic value, and they're willing to wait for the market to recognize their true worth. Now, let's contrast value investing with another popular approach, momentum investing. Momentum investors, unlike their value-oriented counterparts, focus on stocks that are experiencing strong upward price trends, often driven by factors such as positive news flow, earnings surprises, or analyst upgrades. Momentum investors believe that the trend is your friend, and that stocks with strong upward momentum are more likely to continue rising in the short term. They often use technical analysis, which involves studying charts and patterns to identify potential buying and selling opportunities. Momentum investing can be highly lucrative, but it's also riskier than value investing. Momentum stocks are often more volatile and susceptible to sudden reversals, especially if the underlying factors driving their upward trends change. It's important to note that there's no one-size-fits-all approach to investing. The best strategy for you will depend on your individual financial goals, risk tolerance, and time horizon. However, understanding the key principles of both value and momentum investing can provide you with a broader perspective and a more diverse set of tools to navigate the stock market effectively. Now let's talk about some practical steps you can take to enhance your investing journey. One crucial aspect is to develop a solid investing plan. This plan should outline your financial goals, risk tolerance, investment timeline, and asset allocation strategy. Having a clear plan in place can help you stay focused, disciplined, and avoid making emotional decisions based on market swings. It's also important to diversify your portfolio. This means spreading your investments across different asset classes, such as stocks, bonds, real estate, and commodities. By diversifying, you're essentially reducing the impact of any single investment on your overall portfolio, thus mitigating risk. Another critical element of successful investing is patience. Building wealth takes time, and it's essential to resist the urge to chase quick profits or panic during market downturns. Remember, the stock market is cyclical, and downturns are a natural part of its long-term upward trajectory. By staying the course, remaining invested, and continuing to invest regularly, you're positioning yourself to benefit from the power of compound growth. Compound growth is like a financial snowball effect. As your investments generate earnings, those earnings are reinvested, generating even more earnings over time. The longer you stay invested, the more powerful this effect becomes. It's the key to building significant wealth over the long term. Investing is not merely about picking stocks. It's about cultivating a mindset of financial prudence, discipline, and long-term thinking. By embracing these principles, consistently expanding your knowledge, and seeking guidance from reputable financial advisors when needed, you're empowering yourself to navigate the complexities of the financial world with confidence and achieve your financial dreams. Now, let's address a common question among investors. How much money should I be investing? While there's no magic number that applies to everyone, a good rule of thumb is to invest at least 15% of your pre-tax income for retirement. However, the ideal amount for you will depend on your individual financial circumstances, goals, and risk tolerance. Start by creating a budget that tracks your income and expenses, identifying areas where you can potentially reduce spending or increase your income. The goal is to free up as much cash flow as possible to allocate towards investing. Remember, investing is a marathon, not a sprint. Start small if you have to, and gradually increase your investment contributions as your income grows. Even if you can only afford to invest a small amount each month, the most important thing is to develop the habit of consistent investing. Over time, those small contributions can add up to significant wealth, thanks to the power of compound growth. Investing in the stock market offers a fantastic avenue for achieving financial independence and securing your future. By understanding the basics, developing a solid investment strategy, and staying committed to your financial goals, you can harness the power of the market to create a brighter financial future for yourself and your loved ones. Remember, the journey of 1,000 miles begins with a single step. Take that step today and embark on your path to financial freedom. As always, thanks for joining me on Simple Mind Space. If you found this information valuable, please hit that like button, subscribe to the channel, and share this video with anyone who might benefit from learning about investing. Until next time, happy investing, and here's to your financial success.